Berkshire Hathaway Incorporated. To the shareholders of Berkshire Hathaway Incorporated, our gain net return in 2007 was $12.3 billion, which increased the per share book value of both our Class A and Class B stock by 11%. Over the last 43 years, that is since present management took over, book value has grown from $19 to $78,008. Our rate of 21.1% compounded annually. All per share figures used in this report apply to Berkshire's A shares. Figures for the B shares are 1/3 of those shown for the A. Overall, our 76 operating businesses did well last year. The few that had problems were primarily those linked to the housing. Among them are brick, carpet, and real estate brokerage operations. Their setbacks are minor and temporary. Our competitive position in these businesses remains strong, and we have first-class CEOs who run them right in good times or bad. Some major financial institutions have, however, experienced staggering problems because they engage in the weekend lending practices I described in the last year letter. John Strump, CEO of Wells Fargo, aptly dissected the reasoned behavior of many lenders. It is interesting that the industry has invented new ways to lose money when the old ways seem to work just fine. You may recall 2003 Silicon Valley bumper stickers that implored, "Please God, just one more bubble." Unfortunately, this wish was promptly granted as just about all Americans came to believe the house prices would forever rise. That conviction made borrowers' income in cash equity unimportant to lenders who shoveled out money, confident that HPA house price appreciation would cure all problems. Today, our country is experiencing widespread pain because of that erroneous belief. As house prices fall, a huge amount of financial folly is being exposed. You only learn who has been swimming naked when the tide goes out, and what we are witnessing at some of our largest financial institutions is an ugly sight. Turning to happier thoughts, we can report that Berkshire newest acquisition of size, TTI and ISCAR, led by their CEOs Paul Andrews and Jacob Harpaz, respectively, performed magnificently in 2007. ISCAR is an impressive manufacturing operation, as I've seen a view I reported last year, and that was confirmed by a visit I made in the fall to its extraordinary plant in North Korea. Finally, our insurance business, the cornerstone of Berkshire, had an excellent year. Part of the reason is that we have the best collection of insurance managers in the business. More about them later, but we also were very lucky in 2007, the second year in a row free of major insured catastrophe. That party is over. It's a certainty that insurance industry profit margins, including ours, will fall significantly in 2008. Prices are down, exposure inexorably rise. Even if the U.S. has its consecutive catastrophe light year, industry profit margins will probably shrink by 4 percentage points or so. If the winds roar or the earth trembles, results could be far worse. So be prepared for lower insurance earnings during the next few years. Yardsticks. Berkshire has two major areas of value. The first is our investment, stocks, bonds, and cash and equivalents. At year-end, these totaled $141 billion, not counting those in our finance or utility operations, which we assign to our second bucket of value. Insurance float, money we temporarily hold in our insurance operation that does not belong to us. Funds, $59 billion for investment. This float is free as long as insurance underwriting breaks even, meaning that the premiums we receive equal the loss to experiences we incur. Of course, insurance underwriting is volatile, swinging erratically between profits and losses over our entire history. However, we've been profitable and expect we will average break even. Results are better in the future. If we do that, our investments can be viewed as an unencumbered source of value for Berkshire shareholders. Berkshire Share's second component of value is earnings that come from sources other than investment insurance. These earnings are delivered by our 66 non-insurance companies itemized on page 76. In our early years, we focus on the investment side. During the past 2 decades, however, we have put even more emphasis on the development of earnings from non-insurance businesses. The following tables illustrate the shift in the first we tabulate per share investment at 14-year intervals. We exclude those applicable to minority interests. Year 1965, 1979, 1993, 2007. Per share investments $4,577, 13,961, 9,343. Years 1965, 1979, 1979, 1993, 1993, 2007. Compounded annual gain in per share investment 42.8%, 25.6%, 14.3%. For the entire 42 years, the compounded annual gain in per share investment was 27.1%, but the trend has been downward as we increasingly use our available funds to buy operating businesses. Here's a record in how earnings of our non-insurance business have grown, again on a per share basis and after applicable minority interest. Year 1965, 1979, 1993, 2007. Per share pre-tax earnings $4, $18, $212, $4,093. Years 1965, 1979, 1979 to 1993, 1993 to 2007. Compounded annual gain in per share pre-tax earnings 11.1%, 19.1%, 23.5%. For the entire period, the compounded annual gain was 17.8%, with gains accelerating as our focus shifted. Though these tables may help you gain historical perspective and be useful in valuation, they're completely misleading in predicting future possibilities. Berkshire's past record can be duplicated or even approached. Our base of assets and earning is now far too large for us to make outsized gains in the future. Charlie Munger, my partner at Berkshire, and I will continue to measure our progress by the 2 yardsticks I have just described, and we'll regularly update you on the results. Though we can't come close to duplicating the past, we will do our best to make sure the future is not disappointing. In our efforts. We will be aided enormously by the managers who have joined Berkshire. This is an unusual group in several ways. First, most of them have no financial need to work. Many sold us their business for large sums and run the business because they love doing so. So not because they need the money. Naturally, they wish to be paid fairly, but money alone is not a reason to work hard and productively. A second, somewhat related point about these managers is that they have exactly the job they want for the rest of their working years. Almost any other company, key managers below to the top aspire to keep climbing the pyramid. For them, subsidiary or division they manage today is a way station, or say they hope indeed if they are in the present positions 5 years from now, they may well feel like failures. Conversely, our CEO's scorecards for success are not whether they obtain my job, but instead are long-term performances of their business. Their decisions flow from a here today, here forever mindset. I think our rare, hard to replicate managerial structure gives Berkshire a real advantage. Acquisitions. Though our managers may be the best, we will need a large and sensible acquisition to get the growth in operating earnings we wish. Here we made a little progress in 2007 until very late in the year. Then on Christmas Day, Charlie and I finally earned our paychecks by contracting for the largest cash purchases in Berkshire history. The seeds of this transaction were planned in 1954 that fall, only 3 months into the new job. I was sent by my employers, Ben Graham and Jerry Newman, to a shareholders meeting of Rockwood Chocolate in Brooklyn. A young fellow had recently taken control of this company, a manufacturer of assorted cocoa-based items. He had initiated one-of-a-kind tender offering 80 pounds of cocoa beans for each share of Rockwood stock. I described the transaction in a section of 1988 annual report that explained arbitrage. I also told you that Jay Pritzker, the young fellow mentioned above, was the business genius behind the tax-efficient idea, the possibilities for which had escaped all the experts who had thought about buying Rockwood, including my bosses Ben and Jerry. At the meeting, Jay was friendly and gave me an education in the 1954 tax code. I came away very impressed. Thereafter, I avidly followed Jay's business dealings, which were many and brilliant. His valued partners was his brother, Bob, who for nearly 50 years ran Marmon Group, the home for most of Pritzker's businesses. Jay died in 1999, and Bob retired early in 2002. Around then, the Pritzker family decided to gradually sell or reorganize certain of its holdings, including Marmon, a company operating 125 businesses managed through 9 sectors. Marmon's largest operation is Union Tank Car, which together with Canadian counterparts owns 94,000 rail cars. They're leased to various shippers. The original cost of this fleet is $5.1 billion. All told, Marmon has $7 billion in sales and about 20,000 employees. Wilson purchased 60% of Marmon and will acquire virtually all of the balance within 6 years. Our initial outlay will be $4.5 billion, and the price of our later purchase will be based on a formula tied to earnings. Prior to our entry into the picture, the Pritzker family received substantial consideration from Marmon's distribution of cash investment in certain businesses. This deal was done in the way Jay would have liked. We arrived at a price using only Marmon's financial statement, employing no advisors, and engaging in no nitpicking. I knew that the business would be exactly as Pritzker represented. They knew that we could close the dot. However, the chaotic financial markets might have been. During the past years, many large deals have been renegotiated or killed entirely with the Pritzkers, as with Berkshire. As deal is a deal. Marmon CEO Frank Patak worked closely with a longtime associate, John Nichols. John was formerly the highly successful CEO of Illinois Toolworks, ITW, where he teamed with Frank to run a mix of industrial business. Take a look at their ITW records. You'll be impressed. Byron Trott of Goldman Sachs, whose praises I sang in 2003, reported affiliated a Marmon transaction. Byron is a rare investment banker who puts himself in his client's shoes. Charlie and I trust him completely. You'll like the code name that Goldman Sachs assigned that deal. Marmon entered the auto business in 1902 and exited in 1933. Along the way, it manufactured the Wasp, a car that won the first Indianapolis 500 race held in 1911, so this deal was labeled Indy 500. In May 2006, I spoke at launch at Ben Bridge, our Seattle-based jewelry chain. The audience was a number of its vendors, among them Dennis Ulrich, owner of a company that manufactured gold jewelry. In January 2007, Dennis called me suggesting that with Berkshire support, he could build a large jewelry supplier. We soon made a deal for his business, simultaneously purchasing a supplier of about equal size. The new company, the Richline Group, has since made 2 smaller acquisitions, even with those Richline is far below their earnings threshold normally required for purchases. I'm willing to bet, however, that Dennis, with the help of his partner, Dave Molesky, will build a large operation earning good returns on capital employed. Business, the great, the good, and the gruesome. Let's take a look at what kind of business turns us on, and while we are at it, let's also discuss what we wish to avoid. Charlie and I look for companies that have A, business we understand, B, favorable long-term economics, C, able, trustworthy management, and D, a sensible price tag. We like to buy the whole business, or if managers and our partner, at least 80%. We control type purchases of quality and available, though we're also happy to simply buy small portions of great business by way of stock market purchases. It's better to have a part interest in the Hope Diamond than to own all of a rhinestone. Our truly great business must have an enduring enduring moat that protects excellent returns on invested capital. The dynamics of capitalism guarantee that competitors will repeatedly assault any business castle that is earning high returns. Therefore, a formidable barrier such as a company being the low-cost producer Geico, Costco, or possessing a powerful worldwide brand, Coca-Cola, Gillette, American Express, is essential for sustained success. Business history is filled with Roman candles, so companies whose moats proved illusory and were soon crossed are criteria of enduring causes to rule out companies in industry prone to rapid and continuous change. Though capitalism creative destruction is highly beneficial for society, our public is invested in certainty. A moat that must be continuously rebuilt will eventually be no moat at all. Additionally, this criterion eliminates the business whose success depends on having a great manager. Of course, a terrific CEO is a huge asset for an enterprise. At Berkshire, we have an abundance of these managers. Their abilities have created billions of dollars of value that would never have materialized if typical CEOs had been running their businesses. But if a business requires a superstar to produce great results, the business itself cannot be deemed great. A medical partnership led by your era's premier brain surgeon may enjoy outsized and growing earnings, but that tells little about its future. The partnership's moat will go when the surgeon goes. You can count, though, on the moat of the Mayo Clinic to ensure, even though you can't name its CEO. Long-term competitive advantage in a stable industry is what we seek in a business. If that comes with a rapid organic growth, great, but even without organic growth, if the business is rewarding, we will simply take the list of earnings of the business and use them to buy similar business elsewhere. There's no rule that you have to invest money where you've earned it. Indeed, it's often a mistake to do so. Truly great business earning huge returns on tangible assets can, for any extended period, reinvest a large portion of their earnings internally at high rates of return. Let's look at that prototype of a dream business our own sees Candy, the boxed chocolate industry, in which operates as an exciting per capita consumption in the U.S. extremely low and doesn't grow. Many once important brands have disappeared, and only these three companies have earned more than Target's profits over the last 40 years. Indeed, the bulk of its revenues from only few states accounts for nearly half of the entire industry earnings. At See's annually sales were £16 million of candy when Blue Chip Stamps purchased the company in 1972. Charlie and I controlled Blue Chip at the same time and later merged into Berkshire. Last year, See's sold 31 million pounds of growth rate of only 2% annually. That's durable competitive advantage built by the See's family over a 50-year period and strengthened subsequently by Chuck Huggins and Brad Kinsler has produced extraordinary results for Berkshire. We bought See's for $25 million when its sales were $30 million. The capital then required to conduct the business was $8 million. Modest seasonal debt was also needed for a few months each year. Consequently, the company was earning 60% pre-tax on invested capital. Two factors helped minimize the funds required. Operations first, the product was sold for cash and then eliminated accounts receivable. Second, the production distribution cycle was short, in which minimized inventories. Last year's Sea sales were $383 million and pre-tax profits were $82 million. The capital now required to run the business is $40 million. This means we have had to reinvest only $32 million since 1970 to handle the modest physical growth and somewhat modest financial growth of the business. In the meantime, pre-tax earnings have totaled $1.35 billion. All of that, except for the $32 million, has been sent to Berkshire or in the early years to Blue Chip. After paying corporate taxes on the profits, we have used the rest to buy other attractive businesses, just as Adam and Eve, kickstarted an activity that led to 6 billion humans. Seas has given birth to multiple new streams of cash for us. The biblical command, be fruitful and multiply, is one we take seriously at Berkshire. There aren't many C's in corporate America. Typical companies that increase their earnings from $5 million to $82 million require, say, $400 million or so capital investment to finance their growth. That's because growing business have both working capital needs that increase in proportion to sales growth and significant requirements for fixed asset investments. A company that needs large increases in capital to engender its growth may well prove to be a satisfactory investment. There's the follow-through. And for example, nothing shabby about earning $82 million pre-tax on $400 million of net tangible assets, but that equation for the owner is vastly different from the C situation. It's far better to have an ever-increasing stream of earnings with virtually no major capital requirements, ask Microsoft or Google. One example of good but far from sensational business economics is their own flight safety. This company delivers benefits to its customers that are equal to those delivered by any business that I know of. It also possesses a durable competitive advantage. Going to any other flight training provider than the best, it's like taking the low bid on a surgical procedure. Nevertheless, this business requires a significant reinvestment of earnings if it to grow. When we purchased Flight Safety in 1996, its pre-tax operating earnings were $111 million and its net investment in fixed assets was $570 million. Since their purchase, depreciation charges have totaled $923 million, but capital expenditures have totaled $1.635 billion. Most of that for simulators to match the new airplane models that are constantly being introduced. A simulator can cost us more than $12 million, and we have 273 of them. Our fixed assets after depreciation now amount to $1.79 billion. Pre-tax operating earnings in 2007 were $270 million, a gain of $159 million since 1996. That gain gave us a good but far from seas-like return on our incremental investment of $509 million. Consequently, if measured only by economic returns, Flight Safety is an excellent but not extraordinary business. It's put up more to earn more experiences that faced by most corporations. For example, our large investment in regulated utilities falls squarely in this category. We'll earn considerably more money in this business 10 years from now, but we will invest many billions to make it. Now let's move to the gruesome. The worst sort of business, one that grows rapidly, requires significant capital to engender the growth, and then earns little or no money. Think airlines. Your durable competitive advantages have proven elusive ever since the days of the Wright brothers. Indeed, if a far-sighted capitalist had been present at Kitty Hawk, he would have done his successor a huge favor by shooting Orville down. The airline industry demand for capital ever since the first flight has been insatiable. Investors have poured money into bottomless pit, attracted by growth, when they should have been repelled by it, and I to ship my shame and participated in this foolishness when I had Berkshire buy US Air preferred stock in 1989. As ink was drying on our check, the company went to a tailspin, and before long, our preferred dividend was no longer being paid. But we then got very lucky. In one of the recurrent but always misguided bursts of optimism for airlines, we were actually able to sell our shares in 1998 for the hefty gain. In the decade following our sale, the company went bankrupt twice. To sum up, think of three types of savings accounts. The great one pays an extraordinary high interest rates that will rise as the years pass. To the good one pays an attractive rate of interest that will be earned outside deposits that are added. Finally, the gruesome account both pays an inadequate interest rate and requires you to keep adding money at those disappointing returns. In our confession time, it should be noted that the Continental Board of Directors or investment banker pushed me into a mistake I will describe in tennis parlance. They were all enforced errors. To begin with, I almost blew the C's purchase. The seller was asking $30 million, and I was adamant about not going above $25 million. Fortunately, he caved. Otherwise, I would have bulk, and that $1.35 billion would have gone to somebody else. About the time of the C's purchase, Tom Murphy, then running Capital Cities Broadcasting, called and offered me the Dallas-Fort Worth NBC station for $35 million. The station came with the Fort Worth paper that Capital Cities was buying, and under cross-ownership rules, Murph had to divest it. I knew that TV station was seized like business that required virtually no capital investment and had excellent prospect for growth. They were simple to run and showered cash on their owners. Moreover, Murph is now his close friend, a man admired an extraordinary manager, an outstanding human being. He knew the television business forward and backward and would not have called me unless he felt the purchase way was a certain work. And in fact, Murph whispered by into my ear, but I didn't listen. In 2006, the station earned $73 million pre-tax, bringing its total earnings since I turned down the deal to at least $1 billion, almost all available to its owner for other purposes. Moreover, the property now has capital value of about $800 million. What did I say now? The only explanation is that my brain had gone on vacation and forgot to notify me. My behavior resembled that of a politician, Molly Evans, once described. If his IQ was any lower, you would have to water him twice a day. Finally, I made an even worse mistake when I said yes to Dexter, a shoe business I bought in 1993 for $433 million in Berkshire stock, 25,203 shares of A. What I had assessed as durable competitive advantage vanished within a few years, but that's just the beginning. By using Berkshire stock, I compounded this error hugely. That move made the cost of Berkshire shareholders not $400 million, but rather $3.5 billion. In essence, I gave away 1.6% of a wonderful business, one now valued at $220 billion to buy worthless business. To date, Dexter is the worst deal that I've made, but I'll make more mistakes in the future. You can bet on that. A line from Bobby's Beers, country song explained what too often happens with acquisition. I've never gone to bed with an ugly woman, but I've sure woke up with a few. Now let's examine the four major operating sectors of Berkshire. Each sector has vastly different balance sheet and income account characteristics, therefore lumping them together impedes analysis, so we'll present them as four separate businesses, which is how Charlie and I view them. Insurance. The best anecdote I've heard during the current presidential campaign came from Mitt Romney, who asked his wife, "Anne, when we were young, did you ever in your wildest dream think I might be president?" To which she replied, "Honey, you weren't in my wildest dreams." When we first entered the property casualty insurance business in 1967, my wildest dreams did not envision a current corporation. Here's how we did in the first 5 years after purchasing National Indemnity. Year underwriting profit loss float 1967 0.4 $18.5 1968 0.6 21.3 1969 0.1 25.4 1970 0.4 39.4 1971 1.4 65.6. To put it up charitably, we were a slow starter, but things changed. Here's the record of the last 5 years. Year underwriting profit loss float 2003 $1,718 $44,220 2004 $1,551 46,094, 2005, 53, 49,287, 2006, 3,838, 50,887, 2007, 3,374, 58,698. This metamorphosis has been accomplished by some extraordinary managers. Let's look at what each has achieved. Geico possesses the wildest moat of any of our insurers, one carefully protected and expanded by Tony Leslie, its CEO. Last year, again, Geico had the best growth record among major auto insurers, increasing its market share to 7.2%. When Berkshire acquired control in 1995, that share was 2.5%. Not coincidentally, annual ad expenditures by Geico have increased from $31 million to $751 million during the same period. Tony, now 64, joined Geico at 18. Every day since, he has been passionate about the company, proud of how it could both save money for its customers and provide growth opportunities for its associates. Even now, with sales at $12 billion, Tony feels Geico is just getting started. So do I. Here's some evidence. In the last 3 years, Geico has increased its share of the motorcycle market from 2.1% to 6%. We've also recently begun writing policies on ATVs, RVs, and in November, we're at our first commercial auto policy. Geico and National Indemnity are working together in the commercial field, and early results are very encouraging. Even in aggregate, these lines will remain a small fraction of our personal auto volume. Nevertheless, they should deliver a growing stream of underwriting profits and float. General Ray, our international insurer, is by far our largest source of a homegrown float, $23 billion at year-end. This operation is now a huge asset for Berkshire. Our ownership, however, had a shaky start. For decades, General Ray was a Tiffany of reinsurers, admired by all of its underwriting skills and discipline. This reputation unfortunately outlived its factual underpinnings, a flaw that I completely missed when I made the decision in 1998 to merge with General Ray. The General Ray of 1998 was not operated as General Ray of 1968 or 1978. Now, thanks to Joe Brandon, General Ray's CEO, and his partner Todd Montross, the luster of the company has been restored. Joe and Tad have been running the business for 6 years and have been doing first-class business in a first-class way, to use the words of J.P. Morgan. They have restored discipline to underwriting, reserve, and selection of clients. Their job was made more difficult by costly and time-consuming legacy problems, both in the U.S. and abroad. Despite the diversion, Joe and Tad had delivered excellent underwriting results while skillfully representing the company for the future. Since joining Berkshire in 1986, Ajit Jain has built a truly great specialty reinsurance operation from scratch. For a one-of-a-kind mammoth transactions, so the world now turns him. Last year, I told you in detail about the Equitas transfer of a huge cap liabilities to Berkshire for a single premium of $7.1 billion. At this very early date, our experience has been good, but this doesn't tell much because it's just one straw in a 50-year or more wind. What we know for sure, however, is that the on team who joined us, headed by Scott Moser, is first rate and has become a valuable asset for our insurance business. Finally, we have our smaller operations which serve specialized segments of the insurance market. In aggregate, these companies have performed extraordinarily well, earning above average underwriting profits and delivering valuable float for investment. Last year, Boat US, headed by Bill Okerson, was added to the group. This company manages an association of about 650,000 boat owners, providing them services similar to those offered by AAA Auto Clubs drivers. Among the associations offering us is boat insurance. Learn more about this operation by visiting its display at the annual meeting. Below, we show the record of our 4 categories of property casualty insurance. Insurance operations: General Ray, BH Insurance, Geico, other primary. Includes applied underwrites for May 19, 2006. Underwriting profits: 2007, 555, 1,424, 1,113, 279, 3,374. 2006, $526, 1,658, 1,314, 340, 3,838. Year-end float: 2007, 23,009, 23,692, 7,768, 4,229, 58,698. 2006, $22,827, 16,860, 7,171, 4,029, 50,887. Regulated utility business: Berkshire has an 87.4% diluted interest in Mid-American Energy Holdings, which owns a wide variety of utility operations. Largest of these are 1. Yorkshire Electricity and Northern Electric, whose 3.8 million electric customers make it the third largest distributor of electricity in the UK. 2. Mid-American Energy, which serves 720,000 electric customers, primarily in Iowa. 3. Pacific Power and Rocky Mountains Power, serving about $1.7 million electric customers in 6 western states. And 4. Kern River and Northern Natural Pipelines, which carry about 8% of the natural gas consumed in the U.S. Our partners and owners of Mid-American are Walter Scott and its 2 perfect managers, Dave Sokol and Greg Abel. It's important how many votes each party has. We make major moves only when we are unanimous in thinking them wise. 8 years of working with Dave, Greg, and Walter have underscored my original belief Berkshire couldn't have better partners. Somewhat incongruously, Mid-American also owns the second largest real estate brokerage firm in the U.S., Home Service America. This company operates through 20 locally branded firms with 18,800 agents. Last year was a slow year for residential sales, and 2008 will probably be slower. We'll continue, however, to acquire quality brokerage operations when they are available at sensible prices. Here are some key figures on Mid-American's operations. UK Utilities: Iowa Utility, Western Utilities, acquired March 21, 2006. Pipelines, Home Services, other net earnings before corporate interest and taxes, interest other than the Berkshire, interest on Berkshire Junior debt, income tax, net earnings, earnings applicable to Berkshire, debt owned to others, debt owed to Berkshire. Include interest earned by Berkshire net of related income taxes of $70 in 2007, $87 in 2006. Earning in million, 2007, 337, 412, 692, 473, 42, 130, 2086, 312, 108, 477, 1,189, $1,114, 19,002, 821, 2006, 338, 348, 356, 376, 74, 445, 1,737, 261, 1,134, 426, $916, $885, 16,946, $1,055. We agreed to purchase 35,464,337 shares of MidAmerican at $35.05 per share in 1999, a year in which its per share earnings were $2.59, while the odd figure of $35.05 originally decided the business was worth $35 per share to Berkshire is now one of price guy remember sees, and for several days the investment bankers representing MidAmerican had no luck in getting me to increase Berkshire's offer, but finally they caught me in a moment of weakness and I kept telling them I would go to $35.05. With that, I explained they could tell their client they had wrung the last nickel out of me. At that time it hurt. Later on in 2002, Berkshire purchased 6,700,000 shares at $60 to help finance the acquisition of one of our pilot plants. Lastly, in 2006, when MidAmerican bought Pacific Corp, we purchased 23,268,783 shares at $145 per share. In 2007, MidAmerican earned $15.78 per share. However, 77 cents of that was non-recurring. A reduction in deferred tax at our British utility resulted from a lowering of the corporate tax rate, so-called normalized earnings, $15.01 per share. And yes, I'm glad I wilted and offered the extra nickel. Manufacturing, service, and retailing operations. Our activities in this part of Berkshire covered the waterfront. Let's look through at earnings, summary, balance sheet, and earnings statement for the entire group. Balance sheet, 12/31/07 in millions. Assets, cash and equivalents, accounts and notes receivable, inventory, other current assets, total current assets. 2,080, 4,488, 5,793, 470, 12,831. Goodwill and other intangibles, 14,201. Fixed assets, 9,605. Other assets, 1,685. $38,332. Liabilities and equity, notes payable, 1,278. Other current liabilities, 7,652. Total current liabilities, 8,930. Deferred taxes, 828. Term debt and other liabilities, 3,079. Equity, 25,485. Total, $38,322. Earnings statements in millions. Revenues, 2007, 2006, 2005. Operating expenses including depreciation of $955 in 2007, $823 in 2006, and $699 in 2005. Interest expense, $55,026, $49,002, $44,190, $127, $132, $83. Pre-tax earnings, $3,947, $3,526, $2,623. Income tax and minority interest, $1,594, $1,395, $977. Net income, $2,353, $2,131, $1,646. Does not include purchase accounting adjustment. This motley group, which sells products ranging from lollipops to motorhomes, earned a pleasing 22% in average tangible net worth last year. It's noteworthy also that the operations used only minor financial leverage in achieving that return. Clearly won some terrific businesses. We purchased many of them, however, at large premiums to net worth, a point reflecting the goodwill item shown in the balance sheet, and the fact reduces their earnings on our average carrying value to 9.8%. Here are a few newsworthy items about companies in the sector. Shaw, Acme, Brick, Johns, Manville, and Mitech were all hurt in 2007 by the sharp housing downturn, with their pre-tax earnings declining 27%, 41%, 38%, and 9% respectively. Overall, these companies earned $941 million pre-tax compared to $1.296 billion in 2006. So last year, Shaw, Mitech, and Acme contracted for tuck-in acquisitions that will help future earnings. You can be sure they will be looking for more of these. In a tough year for retailing, our standouts were Sears, Borsheim's, and Nebraska Furniture Mart. 2 years ago, Brent Kitzler was made CEO of Sears. We very seldom move managers from one industry to another at Berkshire, but we made an exception with Brad, who had previously run our uniform company, Feckheimer and Cypress Insurance. The move could not have worked out better. In his 2 years, profits at Sears have increased more than 50%. And Borsheim sales increased 15.1%, helped by a 27% gain during shareholder weekend. 2 years ago, Susan Jocks suggested that we remodel and expand the store. I was skeptical, but Susan was right. Susan came to Borsheim's 25 years ago as a $4 an hour saleswoman. Though she lacked a managerial background, I did not hesitate to make her CEO in 1994. She's smart, she loves the business, and she loves her associate. That beats having an MBA degree at any time. On the side, Charlie and I are not big fans of resumes Instead, we focus on brains, passion, integrity. Another of our great managers, Kathy Baron Tamraz, was significantly increased Business Wire's earnings since we purchased early 2006. She is an owner's dream. It is possibly dangerous to stand between Kathy and a business prospect. Kathy, it should be noted, began her career as a cab driver. Finally, at Nebraska Furniture Mart, earnings had a record as our Omaha and Kansas City stores. Each had sales of about $400 million. These, by some margins, are the two top home furnishing stores in the country. And a disastrous year for many furniture retailers. Sales of Kansas City increased 8%, while in Omaha that gain was 6%. Credit remarkable Blancpain Brothers, Ron and Irv, for this performance. Both are close personal friends of mine and great businessmen. Esker continues its wondrous way. Its products are small carbide cutting tools that makes large and very expensive machine tools more productive. The raw materials for carbide is tungsten, mined in China. For many decades, Esker moved tungsten to Israel, where brains turned into something far more valuable. Late in 2007, Esker opened a large plant in Dalian, China. In effect, we've now moved the brains to tungsten. Major opportunities for growth await Esker. Its management team, led by Eitan, Wertheimer, Jacob Harpaz, and Danny Goldman, is certain to make the most of them. Flight Services set record in 2007 with pre-tax earnings increasing 49% to $547 million. Corporate aviation had an extraordinary year worldwide, and both of our companies as runaway leaders in their fields fully participated. Flight Safety, our pilot training business, gained 14% in revenues and 20% in pre-tax earnings. We estimate that we are trained about 58% of our U.S. corporate pilots. Bruce Whitman, the company's CEO, inherited this leadership position in 2003 from Ali Welshi, the father of advanced flight training, and has proved to be a worthy successor. At NetJets, the inventor of fractional ownership of jets, we also remain the unchallenged leader. We now operate 487 planes in the U.S. and 135 in Europe, and fleet more than twice the size operated by our three major competitors combined. Because of our share of the large cabin market is near 90%, our lead in value terms is far greater. The NetJets brand, with its promise of safety, service, and security, grows stronger every year. Behind this is the passion of one man, Richard Santulli. If you were to pick someone to join you in Foxhole, you could do better than Rich. No matter what the obstacle, he just doesn't stop. Europe is the best example of how Rich tenacity leads to success. For the first 10 years, we made a little financial progress. We're actually running up cumulative losses of $212 million after Rich brought Mark Booth on board to run Europe. However, we began to gain traction. Now we have real momentum, and last year earnings tripled. In November, our directors met at NetJets headquarters in Columbus and got a look at the sophisticated operations there. It is responsible for 1,000 or so flights a day in all kinds of weather, with customers expecting top-notch service. Our directors came away impressed by the facility and its capabilities, but even more impressed by Rich and his associates. Finance and finance products. Our major operation in this category is Clayton Homes, the largest U.S. manufacturer and marketer of manufactured homes. Clayton's market share hit a record 31% last year, but the industry volume continues to shrink. Last year, manufactured home sales were 96,000, down from 131,000 in 2003. The year we bought Clayton. At the time, it should be remembered, some commentators criticized directors for selling at a cyclical bottom. Though Clayton earns money from both manufacturing and retailing its homes, most of its earnings come from an $11 billion loan portfolio covering 300,000 borrowers. That's why we include Clayton's operation in this finance section. Despite the many problems that surfaced during 2007 in real estate finance, the Clayton portfolio is performing well. Delinquencies, foreclosures, and losses during the year were at rates similar to those we experienced in our previous years of ownership. Clayton's loan portfolio is financed by Berkshire. For this funding, we charged Clayton 1 percentage point over Berkshire's borrowing cost, a fee that amounted to $85 million last year. Clayton's 2007 pre-tax earnings of $526 million are after it's paying this fee. The flip side of this transaction is that Berkshire recorded $85 million in income, which is included in the following table. Pre-tax earnings in millions. Trading ordinary income, 2007, $272, 60, 111, 526, 157, 1006, 105, 1000, 111. 2006, $274, 29, 282, 513, 159, 1,557, 338, 2,095. Trading ordinary income, life and annuity operation, leasing operations, manufactured housing finance, Clayton, other income before capital gains, trading capital gains. The leasing operations tabulate are extra, which rents trailers in court, which rents furniture. Utilization of trailers was down considerably in 2007, and that led to a drop in earnings. Extra, the company also borrowed $400 million last year that distributed the proceeds to Berkshire, resulting higher interest is now paying further reduces Extra's earnings. Clayton, Extra, and Court are all good businesses. Were very ably run by Kevin Clayton, Bill France, and Paul Arnold. Each has made tuck-in acquisitions during Berkshire's ownership. More will come. Investments, we show below our common stock investment of the year and itemizing those with a market value of at least $600 million. Shares, 151,610,700, 35,560,200, 60,828,818, 200 million, 17,508,700, 64,271,948, 124,939,800, 48,000, 3,486,006, 101,472,000, 17,170,953, 227,307,000, 75,176,000, 26, 17,072,000. 1,192, 19,944,300, 1,727,765, 303,407, 1,668, 1,724,200. Company: American Express Company, Anheuser-Busch Company, Incorporated, Burlington Northern Santa Fe, The Coca-Cola Company, ConocoPhillips, Johnson & Johnson, Kraft Foods Inc., Moody's Corporation, POSCO, The Procter & Gamble Company, Sanofi Aventis, Tesco PLC, U.S. Bancorp, USG Corp., Walmart Stores Incorporated, The Washington Post Company, Wells Fargo & Company, White Mountains Insurance Group Limited, others, total common stocks. Percentage of company owned, cost, market. 12/31/07, 13.1, 4.8, 17.5, 8.6, 1.1, 2.2, 8.1, 19.1, 4.5, 3.3, 1.3, 2.9, 4.4, 17.2, 0.5, 18.2, 9.2, 16.3. 1,287, 1,718, 4,731, 1,299, 1,039, 3,943, 4,152, 499, 572, 1,030, 1,466, 1,326, 2,417, 536, 942, 11, 6,677, 369, 5,238, $39,252. $7,887, $1,861, $5,063, $12,274, $1,546, $4,287, $4,059, $1,714, $2,136, $7,450, $1,575, $2,156, $2,386, $611, $948, $1,367, $9,160, $886, $7,633, $74,999. There's an actual purchase price and also a tax basis. GWP cost differs in a few cases because of write-ups or write-downs that have been required. Overall, we are delighted by the business performance of our investees in 2007. American Express, Coca-Cola, and Procter & Gamble, three of our four largest holding, increased per share earnings by 12%, 14%, and 14%. The fourth, Wells Fargo, had a small decline in earnings because of the popping of the real estate bubble. Nevertheless, I believe its intrinsic value increased, even if only by a minor amount. In the Treasury Department, note that American Express and Wells Fargo were both organized by Henry Wells and William Fargo Amex in 1880. 1850, Wells in 1852, P&G and Cook began business in 1837 1886, respectively. Startups are not our game. I should emphasize that we do not measure progress of our investments by what their market price is during any given year. Rather, we evaluate their performance by the two methods we apply to business we own. The first test is improving earnings with our making do, allowing for industry conditions. The second test, more subjective, is whether their moats, a metaphor for the superiorities they possess that make life difficult for their competitors, have widened during the year. All of the big four scored positively on that test. We made one large sale last year in 2002 and 2003. Berkshire bought 1.3% of PetroChina for $488 million, a price that valued for the entire business at about $37 billion. Charlie and I then felt that the company was worth about $100 billion by 2007. Two factors had materially increased its value. The price of oil had materially increased its value. The price of oil had climbed significantly, and PetroChina's management had done a great job in building oil and gas reserves. In the second half of last year, the market value of the company arose to $275 billion, about what we thought it was worth compared to our other giant oil companies. So we sold our holdings for $4 billion. A footnote, we paid the IRS tax of $1.2 billion on our PetroChina gain. This sum paid all costs of the government, defense, Social Security, name it, for 4 hours. Last year, I told you that Berkshire had 62 derivative contracts that I managed. We also have a few left in General Ray, runoff book. Today, we have 94 of these, and they fall into two categories. First, we have written 54 contracts that require us to make payments for certain bonds that included in various high-yield indicates default. These contracts expired various times from 2009 to 2013. A year in, we have received $3.2 billion in premiums on these contracts, had paid $472 million in losses. In the worst case, though it is extremely unlikely to occur, could be required to pay an additional $4.7 billion. We're starting to make many more payments, but I believe that on premium revenues alone, these contracts will prove profitable, leaving aside what we can earn on the large sums that we hold. Our year-end liability for the exposure was recorded at $1.8 billion, including in our derivative contract liabilities on our balance sheet. The second category for contracts involves various put options. We have sold on 4 stock indices and S&P 500 plus 3 foreign indices. These puts, original terms of either 15 or 20 years, and were stuck at the market. We have received premiums of $4.5 billion, and we recorded a liability at year-end, $4.6 billion. That puts in these contracts are exercisable only at their expiration date, which occur between 2019 and 2027, and Berkshire will then need to make a payment only if the index in question is quoted at a level below that existed on the day that put was written again. I believe these contracts in aggregate will be profitable now, in that we will in addition receive substantial income from our investment of the premium we hold during 15 or 20 year period. Two aspects of our derivative contracts are particularly important. First, in all cases, we hold the money, which means that we have no counterparty risk. Second, the accounting rules for derivative contracts differ from those applying to our investment portfolio, and the portfolio changes in value are applied to the net worth shown on Berkshire's balance sheet, but do not affect earnings unless sell or write down a holding changes in the value of derivative contract. However, must be applied each quarter to earnings. Thus, our derivative positions will sometimes cause large swings in reported earnings, even though Charlie and I might believe the intrinsic value of these positions has changed little. He and I will not be bothered by these swings, even though they could easily amount to $1 billion or more in quarter, and we hope you won't be either. You will recall that in our catastrophe insurance business, we are always ready to trade increased volatility in reported earnings in the short run for greater gains and net worth in the long run. That is our philosophy in derivatives as well. The U.S. dollar weakened further in 2007 against major currencies, and it's no mystery why. Americans like buying products made elsewhere more than the rest of the world's like buying products made in the U.S. Inevitably, that cost America to ship about $2 billion of IOUs in assets daily to the rest of the world, and over time that puts pressure on the dollar. When the dollar falls, it both makes our products cheaper for foreigners to buy and their products more expensive for U.S. citizens. That's why a failing currency is supposed to cure a trade deficit. Indeed, the U.S. deficit has undoubtedly been tempered by a large drop in dollar, but ponder this: in 2002, when euro averaged 94.6 cents, our trade deficit with Germany, the fifth largest of our trading partners, was $36 billion, whereas in 2007, with the euro averaging $1.37, our deficit with Germany was up to $45 billion. Similarly, the Canadian dollar averaged 64 cents in 2002 and 93 cents in 2007. Yet our trade deficit with Canada rose as well, from $50 billion in 2002 to $64 billion in 2007. So far, at least, a plunging dollar has not done much to bring our trade activity into balance. There's been much talk recently of sovereign wealth funds and how they're buying large pieces of American businesses. These are doing not some nefarious plot by foreign governments. Our trade equation guarantees massive foreign investments in the U.S. When we force feed $2 billion daily to the rest of the world, they must invest in something here. Why should we complain when they choose stocks over bonds? Our country's weakening currency is not the fault of OPEC, China, etc. Other developed countries rely on imported oil and compete against Chinese imports just as we do. In developing a sensible trade policy, the U.S. should not single out countries to punish our industries to protect, nor should we take action likely to revoke retaliatory behavior that will reduce America's exports. True trade that benefits both of our country and the rest of the world. Our legislation should recognize, however, that the current imbalances are unsustainable and should therefore adopt that will materially reduce them sooner rather than later. Otherwise, our $2 billion daily force-fed dollars to the rest of the world may produce a global indigestion of an unpleasant sort. For other comments about the unsustainability of our trade deficit, see Alan Greenspan's comments in November 19, 2004, the Federal Open Market Committee minutes of June 29, 2004, and Ben Bernanke's statement September 11, 2007. At Berkshire, we hold only one direct currency position during 2007 that was in hold your breath, the Brazilian real. Not long ago, swapping dollars for real would have been unthinkable. After all, during the past century, 5 versions of the Brazilian currency have in fact turned into confetti, as has been true in many countries whose currencies have periodically withered and died. Wealthy Brazilians sometimes stash large sums into the U.S. to preserve their wealth. But any Brazilian who followed this apparently prudent course would have lost half his net worth over the past 5 years. Here's the year-by-year record index of the real versus the dollar from the end of 2002 to year-end 2007, 100, 122, 133, 152, 166, 199. Every year the real went up and the dollar fell. Moreover, during much of this period, the Brazilian government was actually holding down the value of the real and supporting our currency by buying dollars in the market. Our direct currency positions have yielded $2.3 billion of pre-tax profits over the past 5 years. In addition, we have profited by holding bonds of U.S. companies that are denominated in other currencies. For example, 2001-2002, we purchased 310 million pounds of Amazon.com Incorporated, 67 to 8 of 2010, 57% of par. At the time, Amazon bonds were priced as junk credits, though they were anything but. Yes, Virginia, you can occasionally find markets that are ridiculously inefficient, or at least you can find them anywhere except the finance departments of some leading business schools. The euro denomination of the Amazon bonds was a further important attraction for us. The euro was at 95 cents when we bought in 2002. Therefore, our cost in dollars came to only $169 million. Now the bonds sell at 102% of par, and the euro is worth $1.47 in 2005-2006. Some of our bonds were called and we received $253 million for them. Our remaining bonds were valued at $162 million at year-end. Of our $246 million of realized and unrealized gain, about $118 million is attributable to the fall in the dollar. Currencies do matter. At Berkshire, we will attempt to further increase our stream of direct and indirect foreign earnings. Even if we are successful, however, our assets and earnings will always be concentrated in the U.S. despite our country's many imperfections and unrelenting problems of one sort of another. America's rule of law, market responsive economic system, and belief in meritocracy are almost certain to produce ever-growing prosperity for its citizens. As I have told you before, we have for some time been well prepared for CEO succession because we have 3 outstanding internal candidates. The board knows exactly whom it would pick if I were to become unavailable, either because of death or diminishing abilities, and that would still leave the board with 2 backups. Last year, I told you that we would also promptly complete the succession plan for the investment job at Berkshire when we have indeed now identified our 4 candidates who can succeed me in managing investments. All manage substantial sums currently, and all have indicated the strong interest in coming to Berkshire if called. The board knows the strength of our 4 and would expect to hire 1 or more if the needs arise. The candidates are young to middle-aged, well-to-do, rich, and all wish to work for Berkshire for reasons that go beyond compensation. I reluctantly discarded the notion of my continuing to manage portfolio after my death, abandoning my hope to give new meaning to the term thinking outside the box. Fanciful figures help public companies choose earnings. Former Senator Alan Simpson famously said, "Those who travel the high road in Washington need not fear heavy traffic if he had sought truly deserted streets. However, the senator should have looked to corporate America's accounting." An important referendum in which road business prefer occurred in 1994. America's CEO had just strong-armed the U.S. Senate into ordering financial accounting standards board to shut up by a vote that was 88-9. Before that rebuke, the FASB has shown the audacity by unanimous agreement, no less as corporate chieftains and the stock options they were being awarded represent a form of compensation, and their value should be recorded as an expense. After the senators voted, the FASB, now educated on accounting principles by the Senate's 88 clause at CPA's decreed that companies could choose between 2 methods of reporting on options. The preferred treatment would be to expense their value, but it would also be allowable for companies to ignore the expense as long as their options were issued in market value. A moment of truth had now arrived for America's CEOs, and the reaction was not pretty. During the next 6 years, exactly 2 of the 500 companies the S&P chose the preferred route. CEOs of the rest opted for the low road, thereby ignoring a large and obvious expense in order to report higher earnings. I'm sure some of them also felt that if they opted for expensing, their directors might in future years think twice before approving a mega grants the managers longed for. It turned out for that many CEOs, even low road wasn't good enough. Under the weekend rule, the remaining earnings consequences of options were issued with a strike price below market value. No problem. To avoid that bothersome rule, a number of companies surreptitiously backdated options to falsely indicate that they were granted at current market prices, when in fact they were dished out at prices well below market. Decades of option accounting nonsense have now been put to rest, but other accounting choices remain. Important among these investment return assumption a company uses in calculating pension expense. It will come as no surprise that many companies continue to choose an assumption that allows them to report less than solid earnings. For the 363 companies in the S&P that have pension plans, this assumption in 2006 averaged 8%. Let's look at the chance of that being achieved. The average holdings of bonds and cash for all pension funds is about 28%, and on these assets, return can be expected to be no more than 5%. Higher yields, of course, are obtainable, but they carry with them a risk of commensurate or greater loss. This means that the remaining 72% of assets, which are mostly in equities, either held directly or through vehicles such as hedge funds or private equity investment, must earn 90.2% in order of the fund overall to achieve the postulated 8%, and that return must be delivered after all fees, which are now far higher than they have ever been. How realistic is this expectation? Let's revisit some data I mentioned 2 years ago. During the 20th century, the Dow advanced from 66 to 11,497. This gain, though, it appears to shrink to 5.3% when compounded annually. An investor who owned the Dow throughout the century will also have received generous dividends for much of the period, but only 2% or so in the final years. It was a wonderful century. Think now about the century for investors to merely match that 5.3% market value gain. The Dow recently below 13,000 would need to close about 22 million on December 31, 2099. We are now 8 years into the century, and we have racked up less than 2,000 of the 1,988,000 Dow points the market need to travel in this 100 years, equal to 5.3% of the last. It's amusing. The commentators regularly hyperventilate the prospect of Dow crossing an even number of 1,000. Such as 14,000 or 15,000, if they kept reacting that way, a 5.3% annual gain for the century will mean they experience at least 1,986 seizures during the next 92 years. While anything is possible, does anyone really believe this is the most likely outcome? Dividends continue around about 2%, even if the stocks were to average the 5.3%. Annual appreciation from the 1900s, the equity portion of the plan assets allowing for expenses of 0.5% would produce no more than 7% or so, and 0.5% may well understate costs given the presence of layers of consultants and high-priced managers, helpers. Naturally, everyone expects to be be above average, and those helpers, bless their hearts, will certainly encourage their clients in this belief. But as a class, the helper-aided group must be below average. The reason is simple. 1. Investors overall will necessarily earn an average return minus cost to incur. 2. Passive index investors, though, through their very inactivity, will earn that average minus costs are very low. With that group earning average returns, so must the remaining group. The active investors, but this group will incur high transactions management and advisory costs. Therefore, the active investors will have their returns diminished by far greater percentages than will their inactive brethren. That means that the passive group, the know-nothings, must win. I should mention that people who expect to earn 10% annually from equities during the century and envision that 2% of that will come from dividends and 8% from price appreciation are implicitly forecasting a level of about 24 million on the Dow by 2100. If your advisor talks to you about double-digit returns from equities, explain this math to him. Not that it will faze him. Many helpers are apparently direct descendants of the Queen and Alice in Wonderland, who said, "Why sometimes I've believed as many as 6 impossible things before breakfast." Beware the glib helper who fills your head with fantasies while he fills his pockets with fees. Some companies have pension plans in Europe as well as in the U.S. In their accounting, almost all assume that the U.S. plans will earn more than non-U.S. plans. This discrepancy is puzzling. Why should these companies not put their U.S. managers in charge of the non-U.S. pension assets and let them work their magic on these assets as well? I've never seen this puzzle explained, but the auditors and actuaries who are charged with vetting their return assumptions seem to have no problem with it. What is no puzzle, however, is why CEOs opt for a high investment assumption. It lets them report higher earnings if they're wrong, as I believe the chickens won't come home to roost until long after they retire. After decades of pushing the envelope reverse in its attempt to report the highest number possible for current earnings, corporate America should ease up. It should listen to my partner Charlie. If you hit 3 balls out of bounds to the left, aim a little right to the next swim. Whatever pension cost surprises are in store for shareholders down the road, these jolts will be surpassed many times over by those experienced by taxpayers. Public pension promises are huge, and in many cases funding is woefully inadequate. Because of the fuse of this time bomb, as long politicians flinch from inflicting tax pain given, the problems will only become apparent long after these officials have departed. Promises involving very early retirement, sometimes those in their low 40s, and generous cost of living adjustments are easy for these officials to make. In a world where people are living longer, inflation is certain, those promises will be anything but easy to keep. Having laid out the failures of an honor system in American accounting, I need to point out that this is exactly the system existing at Berkshire for a truly huge balance sheet item. In every report we make to you, we must guesstimate the loss reserve for our insurance units. If our estimate is wrong, it means that both our balance sheet and our earnings statements will be wrong. So naturally, we do our best to make these guesses accurate. Nevertheless, in every report, our estimate is sure to be wrong. At year-end 2007, we show an insurance liability of $56 billion. That represents our guess as to what we will eventually pay for all loss events that occurred before year-end, except for about $3 billion of the reserve that has been discounted to present value. We know many thousands of events have put a dollar value on each that reflects what we believe we will pay, including the associated costs such as attorney's fees that we will incur in the payment process. In some cases, among them claims for certain serious injuries covered by workers' compensation. Payments will be made for 50 years or more. We also include the large reserve for losses that occurred before year-end but that we have yet to hear about. Sometimes the insured itself does not know that a loss has occurred. Think of an embezzlement that remains undiscovered for years. We sometimes hear about losses from policies that covered our insured many decades ago. A story I told you some years back illustrates a problem in accurately estimating our loss liability. A fellow was on an important business trip in Europe when his sister called to tell him that their dad had died. Her brother explained that he couldn't get back, but said to spare nothing when funeral costs would cover. When he returned, his sister told him that the service had been beautiful, presented him with bills totaling $8,000. He paid up, but a month later received a bill from the mortuary from $10. He paid that too. And still another $10 charge he received a month later when a third $10 invoice was sent to him the following month. The perplexed man called his sister to ask what was going on. "Oh," she replied, "I forgot to tell you, we were dead in a rented suit." Other insurance companies, we have a known but mostly certainly large number of rented suits buried around the world. We try to estimate the bill for them accurately. In 10 or 20 years, we will even be able to make a good guess at how inaccurate our present guess is, but even that guess will be subject to surprise. I personally believe our stated reserves are adequate, but have been wrong several times in the past. The annual meeting. Our meeting this year will be held on Saturday, May 3rd. As always, the doors will open at the QS Center at 7 a.m. and a new Berkshire movie will be shown at 8:30. At 9:30, we will go directly to the question and answer period, which will the break for lunch. At the QS stands will last until 3. Then, after a short recess, Charlie and I will convene the annual meeting at 3:15. If you decide to leave during today's question periods, please do so while Charlie is talking. The best reason to exit, of course, is to shop. We will help you do that by filling the 194,300 square foot hall and adjoins the meeting area with products of Berkshire subsidiaries. Last year, the 27,000 people who came to the meeting did their part in almost every location, racked up record sales, but you can do better. If necessary, I'll lock the doors. This year, we'll again showcase a Clayton home featuring Acme brick, Shaw carpet, Johns Mansville insulation, Mitech fasteners, Carefree awnings, and NFM's furniture. You'll find that this 1,550 square foot home priced at $69,500 delivers exceptional value, and after you purchase the house, consider also acquiring the Forest River RV, and pontoon boat on display nearby. Geico will have a booth staffed by a number of its top counselors from around the country, all of them ready to supply you with auto insurance quotes. In most cases, Geico will be able to give you a special shareholders discount, usually 8%. This special offer is permitted by 45 of the 50 jurisdictions in which we operate. One supplemental point, the discount is not additive. If you qualify for another such as a given certain groups, bring the details of your existing insurance and check out whether we can save you money. For at least 50% of you, I believe we can. On Saturday at the Omaha Airport, we will have the usual array of aircraft from NetJets available for your inspection. Stop by the NetJets booth at the Q West to learn about using these planes to come to Omaha by bus, leave in our new plane, and take all the hair gel and scissors that you wish on board with you. Next, if you have money left, visit the Bookworm, where you will find about 25 books and DVDs, all discounted, led again by Port Charlie's Almanac, without any advertising or bookstore placement. Charlie's book has done remarkably, sold nearly 50,000 copies. For those of you who can't make the meeting, go to portcharliesalmanac.com to order a copy. An attachment to the proxy material that is enclosed with this report explains how you can obtain the credential you will need for admission to the meeting and other events. As for plane, hotel, and car reservations, we have again signed up American Express, 800-799-6634 to give you special help. Carol Peterson, who handles these matters, does a terrific job for each year, and I thank her for it. Hotel rooms can be hard to find, but work with Carol and you will get one. The Nebraska Furniture Mart, located on 77-acre site on 72nd Street between Dodge and Pacific, we will again be having Berkshire Weekend discount pricing. We initiated this special event at NFM 11 years ago, and sales during the weekend grew from $5.3 million in 1997 to $30.9 million in 2007. This is more volume than most furniture stores and register in a year. To obtain the Berkshire discount, you must make your purchase between Thursday, May 1st and Monday, May 5th, inclusive, and also present your meeting credential. The period's special pricing will even apply to the products of several prestigious manufacturers that normally have ironclad rules against discounting, but which in the spirit of our shareholder weekend have made an exception for you. We appreciate your cooperation. NFM is open from 10 a.m. to 9 p.m. Monday through Saturday and 10 a.m. to 6 p.m. on Sunday. On Saturdays here from 5:30 p.m. to 8 p.m. NFM is having a Baja Beach Bash featuring beef and chicken tacos. At Border Times, we will again have two shareholders only events. The first be cocktail reception from 6 p.m. to 10 p.m. on Friday, May 2nd. The second Dwayne Gala will be held on Sunday, May 4th from 9 a.m. to 4 p.m. on Saturday will be open until 6 p.m. We will have huge crowds of Border Times throughout the weekend for your convenience. Therefore, shareholder prices will be available from Monday, April 28th through Saturday, May 10th. During that period, please identify yourself as shareholder representing your meeting credentials or brokerage statement that shows you're a Berkshire holder. On Sunday and 10th, outside of Border Times, the blindfolded Patrick Wolf, twice U.S. chess champion, will take on all comers who will have their eyes wide open in groups of 6. Nearby, Norman Beck, a remarkable magician from Dallas, will bewilder onlookers. Additionally, we'll have Bob Hammond and Sharon Osberg, two of the world's top bridge experts, available to play bridge with our shareholders on Saturday afternoon. Course will again be open exclusively for Berkshire shareholders on Sunday, May 4th, and will be serving from 4 p.m. until 10 p.m. Last year, Goris, which seats 240, served 915 dinners on Shareholder Sunday. The 3-day total was 2,487, including 656 T-bone steaks, the entree preferred by the cognoscenti. Please remember that to come to Goris on that day, you must have a reservation. To make one call for 02-551-3733 on April 1st, but not before. We will again have a reception at 4 p.m. on Saturday afternoon for shareholders who have come from outside of North America. Every year, our meetings draws many people from around the globe, and Charlie and I want to be sure we personally greet those who have come so far. Last year, we enjoyed meeting more than 400 of you from many dozen of countries. Any shareholders who come from other than U.S. or Canada will be given a special credential instruction for attending this function. At 84 and 77, Charlie and I remain lucky beyond our dreams. We were born in America, had terrific parents who saw that we got good educations, have enjoyed wonderful families, and great talent, and came equipped with a business gene that allows us to prosper in a manner usually disproportionate to that experienced by many people who contributes as much as more to our society's well-being. Moreover, we have long had jobs that we love in which we are helped in countless ways by talented, cheerful associates. Every day is exciting to us. No wonder we tap desk work, but nothing is more fun for us than getting together with our shareholder partners at Berkshire annual meeting. So join us on May 3rd at the QS for annual Road Talk for Capitalists. We'll see you there. For Bread 28, Warren E. Buffett, Chairman of the Board.